Have you ever heard the term forced appreciation and thought, what's that? Well, in today's video, I'm going to go fully in depth into what forced appreciation is, why it's so great in helping you grow your portfolio, and how you can do that with us here today. And it's all going to begin right after this. Hi everyone, I'm Josh Tavares, investor and realtor at the eXp Realty Brokerage. If you're so nice, if you can help us out, hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And if you guys want access to great cash flowing properties at a low price point, and you want to have no obligations on having to deal with tenant concerns of anything of that sort, then click the link below. Let's book an appointment and let's help you grow your portfolio, and let's partner together. And without further ado, let's begin. Now, forced appreciation is having an asset and having the ability to change the outcome of increasing its value. Now, one of the only ways to actually go about doing so is through real estate investing. You have the ability to go about purchasing a property and changing its value, which is called forced appreciation. Now, with stocks, bonds, gold, crypto, you won't be able to do much. You'll just be able to have the ability to control when you buy, when you sell, and you won't be able to make much of a difference unless you have millions, if not hundreds of millions or billions of dollars that you'll be able to enhance the stock based on the amount of money you're putting in or taking out of a potential stock or asset as we've already listed. Now with real estate, you have the ability to purchase, like we said before on this channel, purchase a rundown property, provide some cosmetic updates such as flooring, painting, changing some appliances, increasing the value of the property, and then being able to rent that property out to a much better clientele, given that this property, of course, is going to be in a great area with great economic fundamentals that's driving the neighborhood upwards, increasing the value. So by buying this property, putting a little bit of work in, you've increased the value, you've increased the perception of the property, which essentially is going to help you grow your portfolio or just grow your own net worth by just doing a little bit of work and helping it grow. Now, for some investors, they believe in going about buying turnkey properties already done up as is, forced appreciation, which is great. No, that's how we began. However, you don't have the ability to increase the appreciation to help you scale and refinance in a short time frame. You'll have to have the market do its thing, increase, as well as while you're also paying down the mortgage to increase the equity as well. Where by purchasing property, like we said already, that's already run down, you're increasing the value, and essentially in months, you'll be able to use that equity to multiply your portfolio to multiple properties. Forced appreciation is one of the wonderful ways that you can go about winning with real estate. Like we've said before, it's cash flow, mortgage pay down, asset appreciation, forced appreciation, tax advantages, and just so much that you can benefit with real estate investing you can't really with any other asset. Now, yes, we are investing now in the US market given the low price point and the great cash flow. However, we're very strategic. We're going to investing because there's certain areas like in the Miamis, the New Yorks, the San Franciscos, where the prices are very expensive now and it's very difficult to cash flow. And also not many people have those kinds of funds to go about investing into a rental property. We want to go into markets where essentially they're about $100,000, maybe a little bit higher, a little bit lower. We're able to get great rents, have excellent cash flow, enough that we can go about having either equity in a home that we can refinance, we have cash set aside, even inheritance of some sort, that we can purchase the property outright in full and have the ability within a short time frame to use equity to extract, to purchase multiple properties. It's exactly what we're doing today with what we're doing in the US market, and it's fantastic. And if we would have known better, we would have probably started this much sooner. And when we go about looking for these markets, we're looking at markets that are a little bit more sustainable, not markets that, you know, in a couple of years they could just go sky high and then drop low. We'd rather be in markets that there's still great appreciation, which helps, of course, increase our property value, but also something that's more sustainable over the long term. Especially that's why we look for economic fundamentals. So we're looking for areas that have great job growth. They have a lot of people migrating to the area. We've got big companies coming in. We're seeing a reduction of taxes. Anything that's going to help business development, help have more opportunities to have more businesses, have more employees go about, of course, these businesses hiring, and having these employees are going to have somewhere they need to live. And many of them come here and they begin renting. And of course, we want to start renting from those high quality individuals who have great jobs in these areas that we can go about leveraging our rental properties to benefit and need. Of course, we need tenants to pay our rent and they need a home. So it's the perfect marriage. Now going back to forced appreciation, a big component of it, of course, is renovation. With renovation, you have to be able to manage your team. Now, essentially, we're in a different country. We can't just keep going, past the border every other weekend to see how things are going. So essentially, we have a wholesale, we have our team that goes about having properties that are run down, they renovate them, and we're able to have that purchase the property at still below market value, but enough, of course, that the team that we're working with, of course, is going to still have some sort of returns with what they've invested into the property, in which within a short time, we'll still be able to refinance and use those funds to grow our portfolio. So this way, we're not getting our hands dirty. We don't have to go on site and go past the border every other weekend or whatnot to make sure that the contractors doing their thing. We have our team in place that goes about finding the deal, has the contractors, gets all this done, and it's as turnkey as it possibly can get while still having some upside than a full turnkey, no equity situation, where in this case, we have equity into the game and we don't have to worry about any contractor scams or any problems with contractors or any delays that's just going to increase our cost and delay the time of the work being done. With forced appreciation, I will say that the better of appliances and the layout and everything is such you're investing into the property, paint, flooring, everything is of course going to impact, of course, the amount that you're paying, but the better tenant clientele. So if there's certain areas that you're going to cheap out on in terms of quality, you want to know what you're putting money into and what not to. And essentially, you want to invest money into things that, of course, are lower cost, durable, but still look really, really nice. Like for flooring, you don't have to have hardwood flooring. You could have really nice, durable laminate flooring that still looks really, really nice, but it's going to last longer and not cost you so much money. Also increasing value as well. Paint, tile work, some bathroom work. You don't have to get the most expensive of everything. You just want to get things that look really, really nice, that are modern, while at the same time aren't going to be that expensive and break the bank. Unfortunately, some investors who are maybe not as experienced might go about buying the most expensive of the appliances, the most expensive of flooring, the most expensive paint and everything, get the most expensive contracting team, have a lovely finish, probably blow over $100,000 just on a kitchen, and then find out that they spent way too much, and then the rent they're receiving doesn't rectify the amount of cash flow they had projected, which is unfortunate because you spend so much money, you want to receive that all back, where you could have, of course, got something that looked really nice, but also at a lower cost to get more into your pocket. Now, some other ways you can go about increasing the value in your property while also increasing your income is having separate laundry machines, or essentially if you want a coin laundry. Now, I will say a coin laundry might not help in terms of the clientele, but definitely a separate laundry can allow you to have the ability to increase the amount of rent you'd have per unit. If you have an unfinished basement, you could always invest into, of course, having it be finished, depending on, of course, if it all makes sense. If it's a basement that doesn't have enough heightage, you might have to underpin, so this costs you a lot of money. That's something that you'll have to evaluate with your partner, look at your expense, see if that makes sense. Another thing too as well, you could also invest into building a garage. If there's enough space on site, it'll definitely increase the value. And in some parts here in Ontario, you can actually turn that garage into a separate dwelling and receive another like $1,000, $1,500 a month through cash flow, just from the investment of, let's say, $40,000, $50,000 of building the garage unit. You can now use it as an income, and in some lots you'll have enough that you can build a massive garage that you could actually split it and make it an additional unit. So let's say you have a duplex on the property. Now you can essentially form the garage, given the permits and everything as such fits to the code and standards of the area or the city you're investing into. You could have two separate properties that have separate dwellings. So it's kind of like having 4 units on a lot that originally only had 2 units. And these are really strategic ways that investors can go about having the same lot and being able to leverage more out of the same lot. Also too, when going about increasing the value of your property through forced appreciation, I also recommend reaching out to your property management team and reaching out, finding out what's the right improvements to get the best clientele. They're going to be fantastic in knowing what their tenants are looking for your property. So they're great people to talk to, instead of just making the assumption that, we have to go super high on and everything. You can speak to your property management team. They'll give you suggestions. They'll even probably give you access to discounts through programs they may have with, Home Depot, Lowe's, Rona, any places as such, and be able to give you the ability to give you discounts and know exactly the type of improvements to look out for to increase your property's value. Remember, when you're increasing the value of the property through renovations, the renovations are for a certain class of people. Now, it depends on what that is. In your case, you could have, people who are as high as like doctors, CEOs. It could be individuals who, are maybe middle class, individuals who have really low income. You want to cater to those people. And remember, what their living circumstances is different than yours. You know what I mean? It really depends. So you need to know your market really, really well and know the type of clientele you're bringing in, because if you have a property that is not the nicest, it's not the greatest in terms of the finish, and it's not very modern, but you're trying to market doctors, that's an issue. Now, in the opposite effect, you have a gorgeous property, but you're essentially allowing someone who has maybe lower income, who might not care for the property, you may have higher maintenance concerns than had it actually been correctly marketed to the right people or had formed to the right clientele. So it's something you want to have a really good understanding who your audience is and market to them and have the right property that's formed based on their needs. Now, we've already talked about improvements that are going to increase the value of your property, increase your income. How about the ones that are going to lower your expenses, like getting high energy efficient fixtures like toilets, getting shower heads that are energy efficient, getting light fixtures that are energy efficient, anything that absorbs energy in your home, whether it's gas, electricity, or water. Find energy efficient uses or in terms of appliances for those, so you're able to bring down the cost. So at that place, you'll have more cash flow and be able to grow your portfolio better, because the bank's going to want to see in the future the type of income you're generating. And if you're able to keep your expenses low and keeping your revenue high, that's going to look really, really good to anyone in terms of lending for you. I hope that video is super helpful, insightful, and gives you everything that you need to know about forced depreciation, on how to do it the correct way and how it can be done the wrong way. I'm Josh Tavares, investor and realtor at eXp Realty. Be so nice, guys. If you can please help us out, hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And also, like I've said before, if you guys are looking for real estate investing, great cash flow, great appreciation, low price point, come partner with us. Click the link below. Let's book an appointment and get you on your investing ways. Thanks so much for watching, guys. Take care.